Let's take a breath before we do anything dramatic, because what just happened in silver has people reaching for the sell button like it as a fire alarm. Price rips higher, headlines get loud, and suddenly everyone who was confident 5 minutes ago is asking, is this the top? That question feels responsible, it feels disciplined. It also happens to be the exact question investors ask right before they trade a long-term position for short-term comfort. Silver pushing through $100 isn't just another round number getting tagged. It's the resolution of a structure that's been building for roughly 45 years. Markets don't coil that long just to sneeze and go back to sleep. When something bases for decades and then breaks out, you're not looking at a trade. You're looking at a regime shift. And regime shifts done to behave according to the tidy, take profits at resistance playbook most people were taught. Here's the part that messes with people and instincts. You're just still thinking in terms of dollars. Dollars are the measuring stick you've always used, so it feels natural to ask how many more of them you can lock in. But in major monetary transitions, the unit you're measuring in is often the thing losing clarity, while the asset you own is gaining it. That flip in perspective is uncomfortable because it forces you to think in terms of purchasing power, not price. From a structural standpoint, this breakout ranks among the largest in modern capital market history. The only comparable move in scope was copper's breakout in the mid-2000s after a multi-decade base, and that wasn't a quick spike. It was a sustained revaluation that unfolded over years. Big bases create big moves, not because of magic, but because of positioning. Weak hands get worn out over time, supply gets transferred to stronger holders, and when demand finally overwhelms the remaining float, price has very little overhead friction. Now look at prior silver surges for context. Past major advances, even those that came out of much shorter consolidation periods, still managed to stretch well beyond what seemed reasonable at the time. Several historical runs, when adjusted proportionally, extended into what would equate to the $110, $130 zone in today's structure. And those were smaller breakouts with less time, less compression, and less underlying monetary stress behind them. Logically, a larger base should support a larger and longer advance. That does not mean a straight line up. Anyone expecting that is setting themselves up for emotional damage. Powerful bull markets are volatile by nature. They shake, they retrace, they scare people out, and then they continue. The key distinction is between a cyclical correction and a secular top. Most investors blur those together because both involve red candles. One is a pause in a larger move. The other is the end of the story. We don't have the hallmarks of the latter yet. Technically, there are a couple of reasonable near-term paths. One scenario has silver pushing a bit higher from here, maybe into the $105, $110 zone, before cooling off and revisiting the $80 area to build fresh support. Another possibility is a sharper extension toward $125 or even $130, followed by a deeper but still structurally healthy retracement into the high 80s or low 90s. Notice what's missing in both cases: a collapse back to the old range. When a market truly breaks out of a multi-decade base, prior ceilings tend to become distant memories, not magnets. Those pullbacks, if and when they happen, are not evidence the move failed. They're how markets reset sentiment and transfer supply from nervous hands to patient ones. If you decide every correction means you were wrong, you'll keep selling strength and buying back higher. The financial equivalent of switching lines at the grocery store and somehow always picking the slower one. Zooming out helps anchor expectations. One of the most informative tools here isn't silver's price alone, but its relationship to gold. The gold to silver ratio tells us how many ounces of silver it takes to buy 1 ounce of gold. At major historical peaks in hard asset cycles, that ratio has compressed dramatically, often into the mid-teens or even lower. Today, even after silver's move, the ratio is still far above those historical extremes. That suggests we may be early in a relative sense, with silver still having room to outperform if the broader precious metals cycle continues maturing. Now layer in the macro backdrop. Debt levels are structurally higher than in prior cycles. Currency debasement is no longer a fringe topic. It's fiscal policy with better branding. Real interest rates remain a battleground, and trust in financial institutions isn't exactly at a generational high. Hard assets tend to reprice during periods when confidence in paper promises erodes. That repricing doesn't happen politely or on a tidy schedule. So if the goal isn't simply sell high, what's the framework? First, separate trading capital from wealth preservation capital. If you're actively trading, trimming into strength and re-adding on weakness can make sense within a rules-based system. But long-term holdings meant to protect purchasing power should not be managed with the same reflexes you'd use for a tech stock momentum trade. Second, think in ratios, not just dollars. Instead of asking, should I sell silver for cash? A more useful question might be, is there another real asset offering better relative value? That could mean rotating a portion into gold if the ratio gets historically stretched, or into productive assets like energy, farmland, or quality equities if their valuations become unusually attractive relative to metals. You're not exiting the lifeboat. You're just moving to a different seat. Third, predefine your behavior before volatility forces the decision. For example, you might decide in advance that if silver corrects 20 to 25% within a broader uptrend, you add incrementally rather than panic. Or if your allocation grows far beyond your target percentage of net worth due to price appreciation, you rebalance a slice into other tangible assets. That's discipline. Hitting sell because a headline scared you is not. Also, understand the difference between price risk and counterparty risk. Physical metal held directly carries volatility, yes, but no reliance on someone else's balance sheet. Paper instruments may be convenient for liquidity and trading, but they introduce layers of exposure that matter more in stressed systems. Your mix should reflect your objectives, time horizon, and tolerance for both types of risk. Tax considerations, liquidity needs, and personal cash flow requirements matter too. If selling a portion meaningfully improves your life, reduces high-interest debt, or funds a durable asset, that's a rational exchange. Converting long-term protection into depreciating consumption because price feels high is a different story. One builds resilience, the other just creates a nicer version of the same vulnerability. The biggest psychological trap right now is the urge to feel clever. Calling a top, locking in gains, telling the story later, it's seductive. But secular bull markets in monetary metals tend to be defined less by perfect exits and more by the simple, boring ability to sit through volatility while the larger thesis plays out. Boring rarely makes for great cocktail conversation, but it often makes for better outcomes. We are not at a point where public participation is euphoric, where mainstream portfolios are overloaded with metals, or where valuation extremes relative to other real assets are flashing red across the board. Those conditions typically accompany major tops. Instead, we're seeing the early stages of broader recognition, where skepticism is still common and positioning, while growing is far from manic. Could this move cool off? Absolutely. Markets breathe. But a pullback within a new structural uptrend is very different from the end of a cycle. If you treat every dip like doom, you'll keep handing your long-term insurance to someone who understands the difference. So before you rush to convert ounces back into currency units that are being created by the trillions, step back and ask a better question than, should I take profits? Ask, what exchange, if any, actually improves my long-term purchasing power and resilience? If you don't have a clear, thought-through answer to that, doing nothing might be the most sophisticated move you make all year. Before we get carried away with price targets that sound like lottery numbers, let's ground this in structure. Markets don't just levitate forever, even in powerful bull phases, and silver is no exception. If we do see a meaningful pullback, there's a technical level sitting just under the surface that deserves your attention, the high 70s, right around $79. That zone lines up with a Fibonacci extension, and more importantly, an area that previously acted as resistance during the late December and early January battle. Old ceilings often become new floors. It is one of those market behaviors that shows up so often it stops being mystical and starts being practical. Now imagine silver runs to $110 or $120 first, and then pulls back to that $79, $80 area. That's a 30-35% correction. Nobody enjoys watching that happen to their account balance. It feels dramatic, it feels personal, and it will absolutely convince a lot of people that the bull market is over. But in the context of major secular advances, that kind of retracement is not abnormal. It's almost routine. Strong trends move in waves, not straight lines, and the deeper the prior surge, the sharper the shakeouts tend to be. Even in a more aggressive near-term scenario, where price stretches to $130 or $140 before cooling off, the likely structural floor still clusters in the low 80s, maybe dipping briefly toward that same $79 region. The key takeaway is this: barring a truly systemic shock, the probability of silver revisiting $50 in the foreseeable future has dropped dramatically. That was the old regime. Markets, like people, eventually outgrow old apartments. But silver's chart is only part of the story. Something arguably more important is happening in the background, and it's happening in gold, not just versus the dollar, but versus the stock market itself. Gold, relative to the S&P 500, has just broken out of a base that S been forming for over a decade. 12 years of sideways frustration, now resolving higher. That ratio carving out a classic cup and handle formation and breaking upward is a big deal in capital flow terms. In plain English, this suggests money is beginning to rotate away from conventional equities and toward hard assets. For years, the dominant narrative was that diversified stock portfolios were the only game in town. That worked beautifully in a disinflationary, liquidity-fueled environment. But when gold starts outperforming the S&P on a structural basis, it hints that the market is repricing risk, growth assumptions, and the reliability of financial assets as long-term stores of value. If gold is leading that rotation, silver tends to follow. And when silver follows, it doesn't tiptoe. Because silver's market is smaller and more volatile, capital inflows can have an outsized impact. On top of that, silver wears two hats: monetary metal and industrial input. When investment demand and industrial demand lean in the same direction, price moves can get energetic. Let's call it cardio for your portfolio. Now add another layer: mining stocks. The major mining ETFs and many individual producers have broken out of bases that stretch back roughly 13 years. That's not a short-term trade pattern. That's a generational setup. For the better part of a decade, investors complained that miners underperformed the metals, that management teams destroyed capital, that the sector was uninvestable. And for a long time, those complaints were fair. But underperformance phases are often when accumulation quietly happens. Here's where it gets even more interesting. Mining stocks have started outperforming gold itself. The ratio of GDX to gold breaking out of a long consolidation tells us equity investors are beginning to price in operational leverage to higher metal prices. That is typically something we see in the earlier to middle stages of a precious metals bull market, not at the very end when everything is already euphoric. Despite the recent surge, the allocation of capital to mining ETFs relative to the broader equity ETF universe remains historically low. In past secular peaks, that slice of the pie was much larger. Today, it's still a niche corner of the market. That suggests the big generalist flows, large institutions, momentum-driven allocators, the crowd that shows up when something is already obvious, haven't fully arrived. When they do, moves can accelerate in ways that make today's action look tame. That said, there's a yellow light flashing in the short term. The percentage of mining stocks making new 52-week highs has spiked sharply. When nearly half the components in an index are hitting fresh highs at once, it tells you momentum is strong, but also potentially stretched. Historically, readings like this often precede at least a cooling off period, if not a sharper pullback. It's the market's version of everyone talking at once at a party. Fun, but it rarely lasts all night. This is where nuance matters. If you sitting on large gains in mining shares, the kind that make you double-check your brokerage app just to be sure. Trimming a portion can be sensible risk management. That's different from panic selling everything. Lightening up into strength, raising some dry powder, and preparing to re-engage after a reset is a tactical decision. It's about managing volatility, not abandoning the thesis. But don't confuse trading positions with core holdings. Physical gold and silver held as long-term monetary insurance serve a different purpose than mining equities or leveraged instruments. Your core metal is not there to maximize quarterly returns. It's there to preserve purchasing power through monetary turbulence. Selling that because a chart looks overbought is like canceling your home insurance because you haven't had a fire lately. So how do you make rational exchange decisions without guessing or getting swept up in emotion? A structured framework helps. The first filter is what you might call the system signal. Are we in an environment of monetary stability, disciplined fiscal policy, and calm bond markets? Or are deficits expanding, currencies being diluted, and central banks quietly accumulating gold? Right now, the broader backdrop leans toward the latter. That argues for maintaining, not reducing, core protection. The second filter is the ratio signal. Instead of obsessing over the dollar price of silver, ask what silver can buy. How many ounces for a quality piece of land? A cash-flowing business? Essential equipment? When real, productive assets become historically cheap in silver terms, that's when exchanging metal for those assets can make strategic sense. Most people do the opposite. They trade hard assets away when real things are expensive and paper feels comfortable. The third filter is personal reality. Life is not a spreadsheet. If you need liquidity for an emergency, to eliminate high-interest debt, or to fund an opportunity that improves your long-term resilience, using a portion of your holdings is rational. The goal is not to hoard metal for bragging rights. The goal is to convert stored purchasing power into a stronger, more secure life when the timing and terms are favorable. Bringing it back to today's market action, we're seeing early signs of a broader reallocation toward hard assets, confirmed across metals, miners, and relative performance versus equities. We're also seeing short-term conditions that suggest things could get choppy. Both can be true at the same time. The art is responding to the short term without losing sight of the long term. Volatility will test conviction. Corrections will feel bigger in the moment than they look on a long-term chart. But if the structural breakout we're witnessing is indeed part of a larger monetary revaluation, then the biggest risk may not be enduring a pullback. It may be stepping aside too early and trying to chase your way back in later at higher prices. Let's zoom out for a second, because what we're witnessing isn't some abstract theory from an economics textbook. This is unfolding in real time, right in front of us. Capital is moving in unusual ways. We're seeing stock indices push to fresh highs while gold is also breaking out. Historically, those two things don't usually happen together for long. When they do, it often points to one underlying force: excess liquidity and a quiet loss of confidence in the currency itself. That's an uncomfortable idea, especially if most of your life you've measured success in dollar terms. But when both financial assets and hard assets are rising at the same time, it's often less about genuine prosperity and more about the measuring stick shrinking. In that kind of environment, swapping tangible stores of value for more currency units can be the financial equivalent of trading a sturdy umbrella for a stack of weather reports. So when people ask when it makes sense to sell silver, the answer isn't tied to a specific dollar price. It's tied to what that silver can actually acquire in the real world. The objective isn't to accumulate the most paper, it's to convert stored purchasing power into something that improves long-term resilience and quality of life. That might be productive land, a business that throws off cash flow, or a hard asset purchased at a historically favorable ratio. Until those conditions show up, exchanging metal for currency just because the number looks big may be more emotional than strategic. If we are indeed moving through a broader monetary transition, the nominal price of silver in dollars could become increasingly distorted. Numbers on a screen might rise dramatically without a corresponding increase in real purchasing power. That is why focusing on ratios, what silver buys relative to other real things, becomes far more useful than chasing round number price targets. Right now, silver still doesn't buy an unusually large amount of real-world assets compared to historical extremes. That will change if the cycle continues. When it does, the shift tends to be obvious in hindsight and uncomfortable in the moment. You'll see high-quality assets becoming cheap in metal terms, even if their dollar prices look intimidating. That's the kind of setup where exchanging a portion of metal starts to make structural sense, not because of fear, but because of opportunity. Until then, patience is a position. Corrections will happen, sharp ones. Volatility is not a design flaw in a bull market. It's part of the mechanism that transfers assets from impatient hands to disciplined ones. Confusing a normal retracement with the end of a secular trend is one of the most expensive emotional mistakes investors make. Now, let Guess address the nagging thought that creeps in during every strong move. What if this is the top? What if you hold and the market collapses back to where it came from? It's a fair question. Risk never disappears. But based on long-term structural data, historical analogs, relative performance trends, and the broader monetary backdrop, a full unwind back to old ranges would likely require a dramatic shift in global policy and financial behavior. For silver to revisit much lower long-term levels in a sustained way, you'd probably need to see governments suddenly embrace fiscal restraint, central banks halt or reverse their accumulation of gold, bond markets stabilize without intervention, and confidence in fiat currencies meaningfully rebuild. That's a tall order, and not one currently supported by observable trends. Could we see meaningful pullbacks into the $80 zone? Absolutely. Markets breathe. But a return to deeply suppressed ranges would imply a fundamental reversal in the forces that drove the breakout in the first place. That brings us to risk in practical terms. The risk of holding through a secular bull market is enduring temporary drawdowns and emotional discomfort. The risk of selling too early is missing a disproportionate portion of a long-duration revaluation. Both risks are real, but they're not symmetrical. Recovering from a correction while holding a hard asset is psychologically hard, but financially survivable. Trying to chase back into a runaway market after you've exited your core position can be far more damaging. There is, however, an important tactical distinction when we talk about mining stocks, especially smaller, more speculative names. That corner of the market is showing signs of near-term overheating. A large percentage of miners hitting new highs at once often signals strong momentum, but it can also precede cooling phases. Sentiment can run ahead of fundamentals in the short run, and mining equities are notorious for sharp swings in both directions. If you're sitting on substantial gains in miners, trimming a portion into strength can be prudent. That's not a vote of no confidence in the larger trend. It's just simply acknowledging that leverage cuts both ways and that raising some liquidity during enthusiastic phases gives you flexibility later. The key is moderation, adjusting exposure without dismantling your entire position based on short-term noise. Stepping back, the broader picture shows multiple confirmation signals aligning. Silver has broken out of a multi-decade base. Gold is outperforming not just currencies, but also equities. Mining stocks are breaking long consolidations and beginning to outperform the metals themselves. Capital flows are gradually shifting toward hard assets, while fiscal and monetary pressures continue to build in the background. None of that guarantees a straight path higher, but it does outline a structural shift that typically unfolds over years, not weeks. In this type of environment, hard assets function less like speculative trades and more like financial insurance with upside. You don't cancel your insurance because you haven't had a claim recently. You reassess coverage, make sure the policy still fits your life, and keep it in place while risks remain elevated. That doesn't mean being rigid or dogmatic. Life circumstances matter. If selling a portion of holdings meaningfully improves your stability, reduces high-interest liabilities, or funds a durable opportunity, that's a rational exchange. The guiding principle is intention. Are you converting metal into something that strengthens your long-term position, or are you reacting to short-term price movement and headline-driven anxiety? As we move forward, it's worth reflecting on how you personally measure success in this space. Is it hitting a specific price target, or is it increasing your ability to acquire meaningful productive assets when the time is right? Those mindsets lead to very different decisions under pressure. It's also useful to think ahead. If the monetary system continues to strain and real assets begin to go on sale in metal terms, what would you actually want? Land with utility, a business with durable cash flow, a home purchased without excessive leverage? Having clarity on that before emotions run high makes it much easier to act decisively when genuine opportunity appears. For now, the evidence points to an ongoing structural shift rather than a completed move. Corrections are likely. Volatility is guaranteed. But temporary weakness within a larger trend is not the same as failure. Staying focused on real purchasing power, relative value, and personal resilience helps filter out much of the emotional noise that dominates during big market transitions. The goal isn't to perfectly trade every swing. It is to be positioned on the right side of a long-term shift and to exchange assets thoughtfully when the world offers terms that truly improve your life. Until then, patience, discipline, and a clear framework will carry you a lot further than chasing every headline